All right, you guys, welcome back to Alternative Finance. My name is Alex, and we are cruising along with our Investing 101 series. And today we got one that's a little bit out of order, in my opinion, probably a little bit early to be talking about something like leverage. But the reason we're talking about it here today, you guys, is because I have noticed an all-time high when it comes to the use of leverage. So we just talked about risk. It's probably a good place to talk about this and make sure that we get this out there. So if you are using leverage, you're thinking about using leverage, you want to use leverage, please watch this video before you do so. But before we hop into it, please, if you like this type of content and you're looking forward to this series, please subscribe to the video. That way you can be notified when these videos come along. Like it so we can get it to as many people out there. Feel free to send it to your friends. And without further ado, let's jump into what is leverage. All right, so as always, we are going to start off with a definition. For those of you who listen to my intro and were like, what is this dude talking about? What is leverage? Well, here we go. Leverage is the use of borrowed funds like a loan or margin, which is very common in the investing world to refer to as margin, and you use that loan to increase the potential return on an investment. This allows you to control a larger investment with less of your own money. While leverage can amplify gains, it can also magnify losses. So I'm going to take a minute here, you guys, and we're going to cut the crib mode because this is another moment right now where I absolutely want to take a moment and make a PSA to all you out there who might be considering leverage. Leverage absolutely is a very, very powerful investing tool. It can provide a lot of different things that can be useful. However, if used improperly, leverage can absolutely destroy an investor. So I encourage you, if you are considering this, do your research. Ask your questions. Know what you are doing. Understand the risks because they are significantly amplified when you utilize leverage. Okay? Got it? Let's go. All right, so now that we got that out of the way, how does leverage work? So, first of all, you're borrowing money, right? So, investors use debt to buy more assets than they could afford with their own funds. The borrower is responsible for paying the loan back even if the stock goes down. So, this goes where I was talking about earlier about the possibility of it being devastating to an investor. You borrow money, you buy an investment, and you bear all of that risk. If the stock goes down, you still owe the money back even if the stock goes down. You're going to have to come up with the money to pay them back. Now, why do I make more money? Why do I lose more money? And that's what I like to call the multiplier effect. If the investment performs well, the profit is larger because you're controlling a bigger position. And the lender does not share in your gains. So they lend you money, you make a bunch of money, extra because you're borrowing money, and you don't have to share that extra money you made with the lender. As long as they get paid back, they're good. That's why it can absolutely multiply your gains. But on the flip side of that, when you lose, they do not share in your losses. You have to pay them back in full, even though the stock went down. You're not doing it together. They're just giving you money so you can do what you want to do. You got to pay it back. It's your risk that you're taking. And this creates the potential where you could potentially lose not only your whole investment, but in some cases, even more than your whole investment. So again, exercise caution if you want to use leverage. So Alex, you have effectively scared the pants off me when it comes to leverage. Why would I want to use leverage? What are some common areas that one might use leverage? Let's look at some personal finance examples because these are some areas that most of you probably use them right this very moment. So number one, and a big one, is going to be a mortgage, right? A mortgage is a perfect example of leverage because you come in there with a down payment, right? You give it to a bank, and then they in turn give you a whole lot more money than that to go and buy a property, and you pay them back over time. At that point, if the house appreciates and goes up in value, you're not going to share that profits with the bank. As long as they get their money back, you're good. That is leverage. Likewise, when you use personal loans to fund a business or whatever, that's leverage. Student loans are leverage. You're leveraging that money to go get an education and increase your earnings potential. And finally, even credit cards, which can be very, very dangerous way to use leverage. You got to make sure you can pay that thing off. Otherwise, the interest can eat you up. But these are all pretty common examples of where you might see leverage in your personal finances and your everyday life right now. So what are some areas that people use leverage in investing, right? I have real estate back on here, which kind of is double tapping the mortgage. But the reason I put it on here is because this is a huge way that investors who invest in real estate really make rental properties work, right? They use leverage. They put a down payment down, they end up with a property and with a mortgage, and the goal is to have the rent be more than that mortgage. And they're taking this down payment and turning it into not only cash flow on a monthly basis where it's paying them a profit, but also the money's being used to pay off a mortgage for an asset that they own. Right? So that is the main way that most investors try to make money in real estate. And that's why I have it here separate from, your primary household mortgage. Next up is going to be margin trading, which I put little stars there because we are about to dive into kind of a margin trade example. So margin trading is essentially where they loan you money from your brokerage. If you don't know what that is, go watch our stock video from a couple days ago. And the brokerage will loan you money to buy additional stocks and to trade in the stock market. Another area you see leverage is in options and futures. Won't touch too much on that here today, as well as leverage ETFs. Again, won't go into that a whole bunch here today, but these are all pretty common areas where you will see investors try to use leverage to increase their gains. So let's look at that example that I was talking about. And again, this is going to be purchasing a stock trade using some borrowed money. So good old John and Jane, they want to make a stock purchase using margin. So they contribute $10,000 of their own money and are loaned an additional $10,000 to invest. They then take that $20,000 and buy stock in ABC Company. Okay? So ABC Company stock goes up 10%. What happens? Let's break that down. So you have your $20,000 in ABC Company. We're going to multiply it times 10%. So the 0.1, that is how you do 10%. And that's going to give you $2,000 in gains. Now you made $2,000, and I'm going to divide that by the $10,000 that you originally put in, which gives you a 20% return. Now, wait. You're thinking to yourself, I made that on $20,000, but remember, $10,000 of that $20,000 was not John and Jane's money. The only money they put in was $10,000. So that $2,000 they earned, really that $10,000 they put in allowed them to earn $2,000, which they earn 20% on that investment. If they sell it today, they're going to get $22,000 from the proceeds of that sale. 10 of it will go back. 12 of it will remain in their pocket. They paid $2,000 in profits on $10,000 in investment, 20% gains. They just effectively doubled that return by using margin, right? Because if they would have only put their original $10,000 in and earned 10%, that would have been $1,000. Instead, they get $2,000 because they borrowed $10,000 extra, made the profit, and hopefully sold it and paid it back, right? But what if the stock goes down, right? Let's take a look at that. Now, if ABC Company stock goes down by 10%, now what happens? Well, let's break that down. So $20,000 at a negative 10% return, right? I lost 10%, which means $2,000 in losses is what I have. So essentially, if John and Jane were to go sell that investment here today, they would get $18,000 from the proceeds of that sale. They would owe back the $10,000 that they borrowed, leaving them with $8,000, meaning they lost 20%. Whereas if they would have not borrowed the money in the first place, the stock would have gone down 10%. They would have lost $1,000. So you can see that in this scenario, they effectively doubled their loss by utilizing margin. They exacerbated their loss by a multiple of 2. Now, this is not as bad as it can get when you use margin. And the reason I'm stressing so much caution throughout this video with margin is because what if the stock goes down something like 50%, right? What would happen then? If a stock that you were trading on margin went down 50% in theory, and I say in theory because in reality, there would be something called a margin call. We're not going to talk about that here today, but let's theoretically look at what would happen if the stock went down 50% and there was no margin call, right? At that point, 20,000, 50% loss, you have $10,000 remaining. You go and sell that investment, you owe back $10,000. You are left with nothing at that point. Even though the stock only went down by half, you are completely wiped out in that scenario. And in certain kinds of leverage, it can even get worse than that. So if you are considering using leverage, I say again, make sure you do your research, make sure you do your homework, make sure you know what you are doing and you understand the risks and you are investing accordingly. So big takeaway for the day is when investing with leverage, gains can be astronomical when the investment goes your way because you do not share gains with the lender. But when the investment does not go your way, the lender typically does not share in the loss, which creates a situation where you can lose not only all your investment, potentially even more than that. So if you're looking for more information about leverage, feel free to drop a comment. We're happy to answer any questions you guys got. And if you're looking to use it here today, not only should you be consulting a financial professional, you probably should be consulting a couple of them on this particular topic. But until next time, you guys, I hope you like this video. Please like the video, leave me a comment, subscribe to the channel if you're into this kind of content. We got lots more on the way with the Investing 101 series. And until next time, everybody, that is Finance AF, and I am Alex. Thank you all again.